In this video, we'll show you 3 stocks that could be significantly bigger in the years ahead, yet many investors still have not fully connected the dots. These are businesses positioned at critical choke points of some of the most important technological trends shaping the future. The companies we're discussing today operate in markets where demand is accelerating, competition is limited, and their products are becoming increasingly difficult to replace. The first stock might be the most interesting of all because while everyone is talking about artificial intelligence, very few people are paying attention to the infrastructure that makes AI possible in the first place. That company is Marvell Technology, ticker symbol MRVL. If you ask the average investor which companies benefit from AI, you'll usually hear the same answers. Most people immediately think about graphics processors, some think about cloud computing, others focus on software companies building AI applications. But there is another layer underneath all of that, a layer that becomes more important every single time a larger AI model gets trained, every time a data center expands, and every time billions of pieces of information need to move across a network at lightning speed. Because AI is not just a computing story, it is also a connectivity story. And that is exactly where Marvell sits. Think about it this way. Imagine building the world's most powerful supercomputer. You can have the fastest processors ever created. You can have the most advanced memory chips. You can spend billions of dollars constructing massive AI clusters. But if those components cannot communicate efficiently with one another, the entire system slows down. The bottleneck is no longer computing power. The bottleneck becomes data movement. This is where Marvell's opportunity starts. The company has quietly become one of the most important suppliers of networking and connectivity technologies powering modern AI infrastructure. As AI models become larger and more complex, the amount of data flowing between processors grows exponentially. That requires faster optical connections, more advanced switches, better networking architectures, and custom silicon solutions designed specifically for AI workloads. Marvell is deeply involved in all of those areas, and that is one reason institutional investors have been aggressively accumulating shares. What makes this story particularly compelling is that the financial results are beginning to confirm what management has been saying for several quarters. In the company's first quarter of fiscal 2027, revenue reached approximately $2.418 billion. That represented growth of 28% year over year, but the real headline wasn't the top-line number. It was where that revenue came from. Data center revenue reached roughly $1.833 billion. That means about 76% of Marvell's entire business is now tied directly to data center demand. More than 3/4 of company revenue is now connected to one of the fastest-growing technology markets on the planet. That is a massive transformation, and it shows how quickly AI infrastructure spending is reshaping the business. Profitability is also improving. Non-GAAP earnings per share came in at 80 cents. Free cash flow surged 127% year over year to approximately $483.1 million. Whenever I evaluate a growth company, I pay close attention to free cash flow. Revenue growth is exciting, but cash generation tells you whether the business is creating real economic value. Marvell is doing both. The company is growing rapidly while simultaneously generating substantially more cash. That combination tends to attract institutional investors, but the most important part of the quarter may not have been the results themselves. It was the guidance. Wall Street often focuses on what happened last quarter. The market's biggest winners usually depend on what management believes will happen next, and Marvell's guidance was difficult to ignore. The company guided second quarter revenue to approximately $2.7 billion plus or minus 5%. That implies roughly 35% year-over-year growth. For a company already generating billions of dollars in quarterly revenue, that kind of growth is remarkable. Even more importantly, management significantly increased its long-term outlook. CEO Matt Murphy made a statement that should immediately grab investors' attention. He said they are seeing exceptional AI-related bookings, and as a result, are significantly raising Marvell's revenue outlook for both fiscal 2027 and fiscal 2028. That matters because management teams typically avoid making aggressive, forward-looking comments unless they have strong visibility into future demand. Large technology customers often place orders months or even years in advance. When management starts raising projections across multiple fiscal years, it usually means they are seeing something substantial in their pipeline. Now let's talk about what actually creates Marvell's competitive advantage. Because strong revenue growth alone does not guarantee long-term success. What matters is whether competitors can easily replicate what the company is doing. In Marvell's case, the moat is becoming increasingly difficult to ignore. The company participates across multiple critical areas of AI networking infrastructure. Its portfolio includes 800 gigabit optics. It includes next-generation 1.6 terabit optical technologies. It offers advanced Ethernet switches operating at 51.2 terabits. It provides scale-up optical solutions. It develops data center interconnect modules. And perhaps most importantly, it designs custom silicon for hyperscale customers. That breadth creates an advantage many investors underestimate. The deeper a company becomes embedded inside customer infrastructure, the harder it becomes to replace. Customers do not simply buy a product, they build entire systems around those technologies. Switching becomes expensive, integration becomes complex, and competitors face higher barriers to entry. But Marvell didn't stop there. In February 2026, the company closed two important acquisitions: Celestial AI and XConn Technologies. These deals expand Marvell's capabilities in optical connectivity and advanced interconnect technologies. Why does that matter? Because AI clusters continue getting larger. The bigger the cluster becomes, the more important efficient communication becomes, and the more valuable advanced networking solutions become. The acquisitions effectively strengthen Marvell's position at a time when AI infrastructure spending appears to be accelerating. One of the most fascinating aspects of this story is that retail investors still seem relatively early. Despite the incredible stock performance, online discussion remains surprisingly limited. Many traders have recently begun discussing the possibility of S&P 500 inclusion, particularly around the June 22 timeframe. Yet broader retail attention remains relatively muted compared to many other AI names. In some online investing communities, qualified mentions remain extremely low. That tells me something important. The story is gaining traction among institutions faster than among retail investors. Historically, some of the biggest stock winners experience this exact pattern. Institutional ownership expands first. Retail participation arrives later. By the time everyone is talking about the company, much of the easy money has already been made. That does not guarantee future returns. But it does suggest Marvell may still be earlier in the discovery cycle than many investors realize. Now let's address the elephant in the room. The stock has already performed incredibly well. Shares are up approximately 264% year to date. Whenever a stock experiences that kind of move, investors naturally wonder whether they have missed the opportunity. That is a fair concern. But the more important question isn't how much the stock has already risen. The more important question is whether earnings and cash flow growth can continue expanding over the next several years. Because ultimately, stock prices follow business performance, and right now Marvell's business performance appears exceptionally strong. The AI infrastructure build-out remains in its early stages. Data center demand continues expanding, network complexity continues increasing, and customers continue investing aggressively in next-generation architectures. If those trends persist, Marvell could remain a major beneficiary. Of course, no investment is without risk, and Marvell has several investors should monitor carefully. The first is customer concentration. A significant portion of revenue comes from large data center customers. When a business becomes heavily dependent on a relatively small group of buyers, those relationships become critically important. The second risk involves integration. Acquisitions often look great on paper. Executing them successfully is a different challenge altogether. Management must integrate technologies, employees, customers, and operations while maintaining momentum in the core business. The third risk is financial. During the quarter, Marvell recorded approximately $331.8 million in contingent consideration charges. Investors should understand how acquisition-related expenses impact future profitability. And perhaps the biggest long-term risk is custom silicon insourcing. If major customers eventually decide to bring more chip development in-house, Marvell could face pressure. Because custom silicon has become an increasingly important part of the company's strategy, these risks are real. They should not be ignored. But when I step back and look at the bigger picture, I see a company positioned directly at the center of one of the largest infrastructure spending cycles in modern technology history. AI is creating extraordinary demand for faster networking. AI is creating extraordinary demand for better connectivity. AI is creating extraordinary demand for custom architectures capable of handling unprecedented workloads. Marvell participates in all three, and that combination is exactly why so many institutional investors continue paying attention. The market often rewards companies that solve bottlenecks. Years ago, computing power was the bottleneck. Today, moving data efficiently is becoming just as important. Tomorrow, it may become even more important. Marvell appears positioned on the right side of that trend, and that's why it earns the #1 spot on this list of stocks to buy before they become obvious. If this resonates with you, you're exactly who this channel is for. Please hit the like button, share the video, and leave your thoughts in the comments. Subscribe to the channel so you don't miss out on the next important financial investing update. Remember to do your own research before you invest in any stock. The second stock on this list is a company that most retail investors still know very little about. That company is Astera Labs, ticker symbol ALAB. What's interesting about Astera Labs is that it operates in a part of the AI market that almost nobody talks about. Most investors focus on the stars of the show, the processors, the accelerators, the chips performing the calculations. But what happens when all those components need to work together? What happens when thousands of processors, memory modules, and networking systems need to communicate seamlessly inside a massive AI server rack? That's where things become incredibly complicated, and that's exactly where Astera Labs makes its money. Think about a modern AI data center. It is no longer a collection of individual computers. It is an enormous interconnected system where every component must move information with extreme speed and minimal latency. The challenge is that every new generation of AI hardware increases complexity, more processors, more memory, more data, more communication, and more potential bottlenecks. Astera Labs specializes in solving those bottlenecks. The company designs connectivity silicon that acts as the plumbing inside AI infrastructure. Its technology helps CPUs, GPUs, memory systems, and networking equipment communicate efficiently. Without that connectivity layer, performance suffers. And when companies are spending billions of dollars building AI clusters, performance inefficiencies become very expensive. This is why I find Astera Labs fascinating. The company isn't trying to compete directly in the most crowded parts of the semiconductor industry. Instead, it has positioned itself in a critical niche that becomes more valuable as AI systems become larger and more complex. In investing, some of the best opportunities emerge when a company solves a problem that keeps getting bigger. Astera Labs appears to fit that description, and the financial results suggest customers agree. The company's first quarter fiscal 2026 revenue reached approximately $308.36 million. That represented year-over-year growth of 93%. Let that sink in. 93%. Very few public companies of any size are growing at that pace. Even more impressive, revenue exceeded analyst expectations of roughly $292 million. The company didn't just grow, it outperformed expectations while doing so. And the earnings story was equally strong. Non-GAAP earnings per share came in at 61 cents. Wall Street had expected approximately 54 cents. That marked the fourth consecutive earnings beat. Whenever I see a company repeatedly exceeding expectations, I pay attention. One strong quarter can be luck. Two strong quarters might be timing. 4 straight earnings beats usually indicate management is executing at a very high level. But there was another number that stood out even more. Operating cash flow surged 610% year over year to approximately $74.6 million. That's not a typo. 610%. Many investors focus exclusively on revenue growth, yet cash generation often tells the deeper story. Cash flow helps reveal whether growth is sustainable, whether customers are paying, whether the business model is strengthening, whether profitability is improving. Astera Labs appears to be checking those boxes. Another encouraging sign was gross margin expansion. GAAP gross margin climbed to 76%. That is an exceptionally strong number. High margins often indicate pricing power. They can also signal differentiated technology that customers cannot easily replace. In highly competitive industries, margins tend to get squeezed. When margins remain elevated, it often suggests the company is creating significant value for customers, and management appears confident that demand remains strong. The company guided second quarter revenue between $355 million and $365 million. That guidance implies continued momentum despite already growing at an extraordinary rate. But numbers only tell part of the story. To understand why Astera Labs could become much larger in the future, you need to understand what's driving customer demand. According to CEO Jitendra Mohan, the quarter was powered by robust demand for the company's PCIe 6 portfolio. Revenue increased 14% sequentially and 93% year-over-year to a record level of approximately $308.4 million. That statement highlights something important. This growth is not being driven by a one-time event. It is being driven by products already solving real customer problems. And those problems are likely to become more significant as AI infrastructure scales. Now let's talk about what may be the biggest reason investors are excited about Astera Labs. The Scorpio X Series Smart Fabric Switch. This product could become one of the company's most important growth drivers. The Scorpio X Series is a 320-lane smart fabric switch designed specifically for AI infrastructure. That might sound technical, but the implications are enormous. As AI clusters become larger, communication efficiency becomes increasingly critical. The Scorpio platform is designed to improve how data moves across these massive systems. Management believes the market opportunity could reach approximately $20 billion by 2030. and production ramping is expected during the second half of 2026. That timeline matters because Wall Street often prices future growth years before it fully appears in the financial statements. Investors aren't simply evaluating what Astera Labs earns today. They're evaluating what the company could earn if products like Scorpio gain widespread adoption, and that's where the upside case becomes particularly interesting. Imagine a world where AI infrastructure spending continues growing for another decade. Imagine larger models, larger data centers, larger computing clusters. Every one of those trends increases complexity, and every increase in complexity creates more demand for connectivity solutions. Astera Labs is positioning itself directly in the middle of that trend. The company isn't betting on one specific AI model. It isn't betting on one customer. It isn't betting on one software platform. Instead, it's helping solve infrastructure challenges that exist regardless of which AI applications ultimately dominate. That distinction is important. Sometimes the best investment opportunities come from selling the tools rather than predicting the winner. Another factor worth discussing is investor awareness. Despite the stock's incredible performance, Astera Labs remains surprisingly underfollowed compared to many larger AI names. Retail discussion exists, but it remains relatively concentrated. Most conversations occur inside highly speculative trading communities. Broader mainstream investor awareness still appears limited. That creates an interesting situation. The company is already executing at an elite level. Revenue growth remains explosive. Margins remain strong. Cash flow is improving. Yet many investors still cannot explain what the company actually does. Historically, that combination can create opportunity. When fundamentals improve faster than public awareness, valuations can continue expanding. Of course, we also need to discuss the stock's performance, and there is no denying the stock has already had an extraordinary run. Shares are up approximately 134% year to date. Over the past year, they have climbed roughly 334%. That type of move naturally raises concerns about valuation. Investors begin asking whether all the good news is already priced in. It's a reasonable question, and it's one reason why understanding risk is so important. The first risk involves customer concentration. Like many AI infrastructure companies, Astera Labs relies heavily on large hyperscale customers. When a significant percentage of revenue comes from a relatively small group of buyers, investor confidence becomes tied to those relationships. If spending slows, growth could be affected. The second risk involves margins. Management expects gross margins around 73% in the second quarter. That's still excellent, but it represents modest compression from current levels. Part of that is tied to newer switch products entering the mix. As product portfolios evolve, margin profiles can shift. Investors should monitor whether future growth continues generating attractive profitability, and perhaps the biggest risk is expectations themselves. After a stock rises more than 300% in a year, the market becomes far less forgiving. Investors no longer reward good results, they often demand exceptional results. Any disappointment can trigger sharp volatility. That's simply the reality of high-growth investing. But despite those risks, I keep coming back to one central idea. AI infrastructure is becoming more complex, not less. Every generation of hardware introduces new challenges. Every increase in computing power creates new bottlenecks. And every bottleneck creates an opportunity for companies capable of solving it. Astera Labs has built its business around solving those bottlenecks. That's why many investors believe this company could still be in the early innings of its growth story. The market often pays enormous premiums for businesses that become mission-critical, not necessarily because they're the largest, but because removing them becomes difficult. Astera Labs appears to be moving toward that category, and if management continues executing at its current pace, today's valuation could look very different several years from now. That is precisely why Astera Labs earns the second spot on this list of stocks to buy before they become obvious. This video is brought to you by Value Stocks Investing Master Course. If you're looking to grow your wealth by investing in solid, undervalued stocks but not sure where to start, I created the Value Stocks Investing Master Course to teach you how to identify great companies, make smart investment decisions, and build a portfolio that lasts. Click the link in the description and pinned comments to get the course today and take control of your financial future. The third stock on this list is probably the one that surprises investors the most. That company is ON Semiconductor, ticker symbol ON. And that may be exactly why the opportunity exists. One of the biggest mistakes investors make is assuming the best opportunities are always the most obvious. In reality, some of the biggest winners emerge after sentiment becomes overly pessimistic. When expectations collapse, even modest improvements can create powerful upside. That is the story unfolding at ON Semiconductor today. For much of 2025, investors focused almost exclusively on weakness in the automotive and industrial markets. The narrative was simple: demand was slowing, inventory levels were elevated, growth had stalled, and many investors moved on to more exciting stories. Meanwhile, something important was happening beneath the surface. The company was quietly building exposure to one of the fastest-growing segments of the technology industry: artificial intelligence infrastructure. Today, ON Semiconductor is no longer just an automotive semiconductor company. It is increasingly becoming an AI power infrastructure company, and that distinction could matter enormously over the next several years. To understand why, we need to talk about a challenge that receives far less attention than processors and networking: power. Every AI data center needs electricity, massive amounts of electricity. The more advanced AI systems become, the more power they consume. And once that power reaches the data center, it must be managed efficiently. That is where ON Semiconductor enters the picture. The company specializes in power solutions, power management technologies, silicon carbide solutions, and advanced architectures designed to improve efficiency. As AI infrastructure expands, power efficiency becomes increasingly important, because every watt saved translates into lower operating costs. And when companies are spending billions of dollars building AI infrastructure, efficiency matters a lot. This is one reason why ON Semiconductor's recent financial results deserve more attention than they received. In the first quarter of fiscal 2026, revenue reached approximately $1.513 billion. That represented year-over-year growth of 5%. At first glance, that might not sound particularly exciting, but context matters. Remember, this company is emerging from a cyclical downturn. Investors were expecting weakness. Instead, revenue exceeded consensus expectations of approximately $1.49 billion. The company also delivered stronger than expected earnings. Non-GAAP earnings per share came in at 64 cents compared to analyst expectations of roughly 62 cents. Again, not a massive beat, but it reinforces a broader theme. The recovery appears real, and perhaps the most encouraging sign came from profitability. Non-GAAP gross margin recovered to 39%. A year earlier, that figure was only 20%. That's a dramatic improvement. Whenever margins begin expanding after a difficult period, it often signals improving business conditions. It can also indicate that management's restructuring efforts are beginning to work. But the real breakout story involves AI, and this is where investors should pay close attention. According to management, AI data center revenue more than doubled year over year. Even more impressive, sequential growth exceeded 30%. That is extraordinary growth, especially considering the company is not widely viewed as an AI stock. The market tends to reward companies when investors discover a new growth engine, and AI may be becoming exactly that for ON Semiconductor. CEO Hassan El-Khoury was remarkably direct when discussing the quarter. He stated that the company exceeded expectations as demand strengthened throughout the quarter and that the business has moved beyond the cyclical trough and onto a path toward recovery. He also highlighted that AI data center revenue accelerated significantly, growing more than 30% sequentially. That statement matters, because it suggests AI growth is not simply offsetting weakness elsewhere. It is becoming a meaningful contributor to future growth. Another encouraging signal came from the Power Solutions Group. Revenue there increased 14% year over year to approximately $736.6 million. That is important because Power Solutions sit directly at the center of several long-term trends: artificial intelligence, electric vehicles, energy efficiency, industrial automation. All of those trends require advanced power technologies, and ON Semiconductor participates across each of them. Now let's talk about guidance, because guidance often reveals how management views future demand. The company guided second quarter revenue between approximately $1.535 billion and $1.635 billion. That outlook reinforces the recovery narrative. Management is not acting like a company preparing for another downturn. They're acting like a company seeing strengthening demand, and that difference is significant. One reason I find ON Semiconductor particularly attractive is that investors are essentially getting multiple growth stories in a single company. The first growth story is AI infrastructure, the second is electric vehicles, the third is silicon carbide technology, and the fourth is advanced power architectures. Let's start with AI. Every AI server consumes enormous amounts of electricity. Every AI cluster requires sophisticated power management. As workloads become larger and more energy-intensive, efficient power delivery becomes increasingly valuable. That creates a long runway for companies capable of improving performance while reducing energy consumption. Then, there is silicon carbide. Many investors underestimate the importance of this technology. Silicon carbide enables greater efficiency, higher voltage performance, and improved thermal management. Those advantages are particularly valuable in electric vehicles and high-performance power applications. As electrification expands globally, demand for advanced power solutions could continue increasing. Another area worth watching is the company's work involving 900-volt architectures. Management continues advancing these technologies alongside major automotive programs. While investors often focus on quarterly numbers, these long-duration technology transitions can create significant value over time. And that's one reason I think ON Semiconductor remains misunderstood. The market spent so much time focusing on cyclical weakness that many investors overlooked the company's evolving growth profile. Now let's address the stock itself. Shares have already rebounded sharply. The stock is up approximately 133% year to date. Some investors will immediately conclude they missed the move. Maybe, maybe not. Because the real question isn't whether the stock has already doubled. The real question is whether earnings power several years from now will be substantially higher than it is today. If the answer is yes, future returns may still be attractive, especially if AI data center growth continues accelerating. Now let's discuss the risks, because every investment has them. The first risk involves restructuring. During the first quarter, the company absorbed approximately $329.3 million in restructuring and impairment charges. That's a significant number. While restructuring can improve long-term efficiency, it also highlights the challenges management has been navigating. The second risk involves free cash flow. Free cash flow declined to approximately $217.2 million. Investors should monitor whether future earnings growth translates into stronger cash generation. The third risk involves capital allocation. During the quarter, the company repurchased approximately $345.7 million worth of shares. That exceeded free cash flow generation by a considerable margin. While buybacks can create shareholder value, investors should always evaluate whether they are being funded sustainably. Another challenge remains the analog and mixed signal group. Revenue there declined approximately 5% year over year. That weakness reminds investors that parts of the business are still recovering. Not every segment is firing on all cylinders. Yet despite those concerns, I believe ON Semiconductor represents one of the most interesting risk-reward opportunities on this list. Why? Because expectations remain lower. Marvell is already viewed as an AI winner. Astera Labs is already viewed as an AI winner. ON Semiconductor is still undergoing discovery. Many investors continue viewing it through the lens of its old narrative, the automotive narrative, the cyclical narrative, the recovery narrative. What happens if the market begins viewing it as an AI infrastructure company instead? That shift in perception could be powerful. History shows that re-rating opportunities often generate substantial returns. Not because the business suddenly changes overnight, but because investors finally recognize what was already happening beneath the surface. And that is why ON Semiconductor earns the third and final spot on this list of stocks to buy before they become obvious. If you step back and look at all three companies we've discussed today, a fascinating pattern emerges. Marvell Technology benefits from the movement of data. Astera Labs benefits from connectivity inside AI infrastructure. ON Semiconductor benefits from powering that infrastructure efficiently. Different products, different business models, different markets, but all three sit directly in the path of one of the most important technological transformations of our lifetime. Artificial intelligence is not just creating demand for software, it is creating demand for infrastructure. And infrastructure is where some of the biggest long-term investment opportunities often emerge. If you want exclusive stock tips, in-depth analysis, real-time trade alerts, and free investing guides, join the Stocks Galore Patreon today and take your investing game to the next level. Our members get full in-depth analysis on most of the stocks mentioned here. Head over to patreon.com/stocksgalore and become part of our growing community of smart investors. Link is in the description. Before we wrap up, I want to hear from you. Which company do you think has the strongest long-term competitive advantage? Marvell Technology with its AI networking infrastructure, Astera Labs with its connectivity solutions inside AI systems, or ON Semiconductor with its growing AI power and efficiency business? Let me know your thoughts in the comments below. Do not forget to like the video, share your thoughts in the comments, and subscribe so you do not miss the next important investing update. Thanks for watching, and I will see you in the next one.